What are those ads advertising a guarantee of 7% really all about? Plus, we're going to do our overview and discussion about commodities. Was trying to get to that last week, ran out of time on the program. So we want to set the stage certainly for that in this week's program. A little discussion about commodities, the markets, sort of what drives them, what the future may hold for that type of asset. So welcome to the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. This morning I'm quite cold. I don't know about you, but boy, I was listening to the news lines that were running just prior to the program began, and I guess I'm glad I don't live in South Florida where, those lizards or iguanas, I guess they are, will fall out of the trees and, bonk you on the head and then scurry on off once they get warmer. Only in Florida. We wonder why sometimes this state makes the headlines that it does. That's one for the list. So we hope you are staying warm this morning. Certainly quite cold overnight, and that is sort of abnormal, I guess, for Florida. And I think you could say somewhat the same thing for the markets this past week. Is certainly we had some erratic, necessarily abnormal, probably more erratic is a better word for it, in terms of the behavior. If you were keeping score on an hourly basis, well, we wish you and your blood pressure well, because it was certainly a week where the market saw wild swings on a consistent basis. Starting right off on Monday, 1,000-point drop in the market that wound up not really materializing. And then every other day sort of followed that pattern. Big swings in terms of the overall market. Obviously, the story being dominated by this sort of battle that's going on between what we think the impact of higher interest rates is going to be on the markets, on the economy, on businesses, on consumers, and the offset of what has been happening of late, which is inflation, and how those two ultimately will play out. Of course, nobody knows the answer to that. Stay tuned, as they like to say, but we would imagine that certainly the Federal Reserve is going to have to be raising rates at a pretty good clip this year. And that in and of itself is interesting, because not that long ago, think just a few months ago, Federal Reserve didn't look like they were going to be raising rates at all this year. So there's been a very dramatic and quick pivot by the Fed in terms of its approach on interest rates, particularly in response to inflation. So, but, for the week that was, the overall broad-based markets ended up slightly, about 1%, if you follow the S&P 500. So despite all of that, it wound up being a positive week overall in the markets. But certainly it underscores this notion that the markets are, in fact, quite volatile in the short term. And last week on the program, we talked a little bit about some of the takeaways that investors should have, particularly in this current environment, which is showing obviously some increased volatility. And we talked about this notion that last year, in fact, was perhaps an abnormal year in just how smooth it was without really any volatility. Volatility, we contend, is in fact quite normal, and it's the absence of which is abnormal, which I think has sort of gotten folks into this sort of false sense of security of just how smooth the markets are. So here is the actual data. We alluded to it last week, but it has been since March of 2020, so almost 2 years, since there has been any kind of a 10% correction in the broad-based markets. And in 2021, so last year, last calendar year, there was only one 5% decline in the overall markets during the course of that entire 12-month span. To put those numbers into perspective, since the S&P 500, that index was created all the way back in 1957, on average has been about 10% decline per year, and 3 different times in every single calendar year where you see at least 5% pullback. So 1 on average, that's 10%, 3 on average that are 5%. Last year, you just had 1 that was 5%, and it's been almost 2 years since you've seen any kind of a 10% decline. So perspective, volatility is normal. The absence of it is probably more abnormal. Right now, the S&P 500 stands at a decline of about 7% year to date. So getting close to kind of that territory of correction, if you will. But please understand that doesn't mean you go out and change all your investments, right? Because volatility is normal, and this is all part of it. But sometimes, particularly now when we've had this period of time where things have been relatively smooth, we sort of forget that. Human nature, right? But it is, in fact, quite normal. Speaking of things that are normal, this time of year, it's tax season, right? So tax season starting to gear up, folks starting to receive those tax documents. Keep all of mine kind of in a little file folder, and that file folder was empty about a week or so ago, and now it's starting to get a little thicker on a regular basis. So keep an eye out in your mail for any of those tax documents. Obviously, you're going to need them to prepare your tax return. Hard to believe tomorrow marks the end of January. February will begin, and then you really do start to get in the midst of tax season. 2 things that we really want to emphasize as you start to put some thoughts together for your taxes, particularly your tax return for 2021. So number 1, make sure that you take the time to research the status of that third stimulus check. Once again, 2021 taxes, much like 2020, are going to be a little bit more complicated and a little bit more convoluted because some of the things that happened that were unique to COVID. So last year, another round of stimulus checks that were sent out in March, April, May. You've got to know how much that was and whether you got it, because the IRS knows, and if you report something that is different than what they know, then it's going to cause a delay on the processing of your tax return. And we're seeing that millions and millions of tax returns have gotten delayed as a result of confusion over, did I get it? How much did I get? Where did it go? Things like that. So make sure that you take the time to really track down how much did I get? When did I get it? Particularly as it relates to that third stimulus check that came last year, because you've got to true that up on your tax return for the year 2021. Now, the good news is, as it relates to stimulus checks, if you got it and you're now not eligible for it because your income is higher, don't worry about it. You do not have to give it back. If you didn't get it, but you're eligible for it, that's where it's important to really know, okay, how much did I get, and did I not get it, or did I get it? That's number 1. Number 2, the child tax credit advancements that were getting paid in the back half of last year, those monthly checks. You got to know those numbers. You have to have accurate records of that. The IRS is actually going to be sending out letters that detail those amounts that you got. But here's the thing on that child tax credit. If you got too much and you weren't eligible for it, you're gonna have to pay it back. It's not like the stimulus check. So be aware of that. 2 big issues as it relates to your 2021 taxes. When we get back, we're gonna ask the question of whether these 7% guarantees are really for real. All that coming up here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Is a 7% guarantee for real? Hear a lot of those ads out there today. So on the program, we're going to talk a little bit about what's behind them and how that ultimately really breaks down for investors. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars were Central Florida's longest running radio program. Also happened to be one of the top 25 financial planning podcasts on the World Wide Web, with over 20,000 downloads of our episodes over the course of the past few years. We welcome you. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So, first of all, someone advertising, if you hear an advertisement that there is a guaranteed return of 7%, you do have to sort of stop and think about that for just a second, right? Don't suspend your basic common sense in listening to those ads. Because if interest rates are at zero, right? And how is it possible then for anybody to guarantee 7%, right? I mean, you think of it this way, you think of a guarantee, you think of the risk-free or the riskless security as it's described as the US government treasury. Well, today, that interest rate is at like 1.7, right? So how does someone guarantee 7%, right? I mean, so the first time you hear it, I mean, you really don't on the second or third or fourth time all of a sudden start to suspend your common sense, because there's no way that you can really get a guarantee of 7% if the risk-free or the riskless, the most riskless security or the most riskless investment that you can have out there, which is the US Treasury, is only paying at 1.7, right? So how on earth does that really happen? Bottom line is, anytime you have to suspend that common sense, then the premise that you're probably doing, you probably want to run in that other direction. All right, so what's really happening? Well, first and foremost, what you're hearing about is an annuity product. So again, annuity product is a contract that is issued by an insurance company. There's no insurance company on the world that's able to get a 7% guarantee return. Again, when sort of the baseline for riskless return is viewed as the yield on the US government treasury, which is 1.7. Not possible, because wait a minute, this is an insurance company. This is a private company, generally a publicly traded company, that is somehow engaging in this contract with you on this pie in the sky 7% kind of thing. So the reality is, though, of course, that none of these ads use the A word, right? They never use the A word. They never say it's an annuity. They make it seem like it's something other than that, but that's what it is. It's an annuity. Now, number two, and here's the most important piece, or one of the most important pieces. The 7% guarantee has absolutely nothing to do with the value of your money. That's got nothing to do with it. And I guess that's the biggest source of confusion. When you hear it, you think, oh, my money is going to make 7%. And that's not the case at all. It's on where the 7% comes in is on the insurance company's valuation of that money in a separate account, a separate valuation, if you will, from what your dollars are really worth, called the income base. Now, there's a bunch of other names that they might use to describe it, but basically what it means is that there's two different values going on inside this annuity contract. There's the value of your money, and then there's the value of sort of what the insurance company says is sort of your money. It's over there on that sort of your money side of things where that 7% takes place. Now, here's the thing. In order to tap into this other side, then you've got to elect an income option. Now, understand I said income option and not a withdrawal. There is a difference. If you take a withdrawal, that is coming out of your money. If you take an income option, then that's coming out of this insurance company controlled valuation of what your money really is. So let's think of it this way. If you invest $100,000, that's your money. On the income-based side of things, the insurance company's view of what that money is worth, let's say it goes up by 7%. That's where kind of that 7% comes in these ads. So over a 10-year period of time, the 100,000 turns into 200,000. But that's not your money. You can't take a withdrawal of 200,000. Instead, you have to take income off of that number. Now, here's the thing. The income amount that you can take off of that insurance company income base number is based upon your age. Depending on how old you are, you can take a higher percentage, usually around 65. You can take maybe like 5%. That's it. So the income run-up, that 7%, doesn't in fact allow you to take 7%. How much you're able to take off of that income base is in fact based upon your age. Typically retirees, 65, typically that's around like 5%. So if you got to put 100,000 in of your money, at the 7% number, it goes to 200,000 over 10 years. That's the insurance company's base. That's the insurance company's number. That's the income base upon which you can then draw money from. All right, so now you only can take 5% of that number. So 5% of 200,000, you're going to get $10,000 per year. So the reality is that you never ever actually get to the 7% number, because what happens is how much you can then take from the income base is a function of a percentage based upon how old you are. So the whole thing is the very definition of pie in the sky. You're not going to get the 7%. It's got nothing to do with your money. You're never going to be able to withdraw out an amount of money that represents a 7% return. It's not going to happen. The 7% is purely on a number that you then could potentially draw income from, but that income that you're able to draw is only going to be around 5% plus or minus, depending upon your age. So understand how these work. And folks, anytime you have to suspend common sense to make something make sense, well, don't do it. Because there's no guarantee of 7% when the yield on a U.S. government treasury is 1.7. Not possible. It's just not possible. So don't suspend your common sense when it comes to these products. We're going to take a break. We come back. We're going to talk a little bit about commodities, what drives some of the bigger parts of that particular market. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Commodities. Hearing a lot of conversation about them. Oil, copper, soybeans, orange juice futures. Those are all examples of commodities, and lots of conversation out there these days about them. So we thought it would be good to spend some time sort of explaining what all the fuss is about, what's been driving them, the parts of the conversation that really help to drive large parts of the commodities market. So with that, we welcome you all back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So if you're a big fan of podcasts, or for that matter, YouTube videos, you can subscribe to us on any of your favorite podcast channels of choice. So if you have problems finding said channel, just go to our website, nelsonfinancialplanning.com, and then from there, upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar, and then you can get connected to our channel on your favorite social media platform of choice. My name's Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning. So, hearing a lot about commodities these days, and understandably so. The Bloomberg Commodity Index, which is sort of the measure of the broadest basket of commodity prices, rose about 27% for calendar year 2021. And guess what happens? Anytime something goes up, it always spurs a lot of conversation, right? Because people go, oh my goodness, it went up, and I'm gonna go into it because that must be going to repeat itself every single year going forward, right? That herd mentality starts to take over, particularly when you see a strong year in anything. The problem is that what made the performance in 2021 so unique is that was the strongest performance for commodities as a whole in decades. So the best year in decades last year, up the overall Bloomberg Commodity Index up about 27%. So here's the caveat. Commodities are highly volatile. Big swings on a regular basis. Actually talking to my contractor, we're in the process, as many of you know, of expanding the office. And so we were talking about this the other day, and he's like, the price of wood is just fluctuating like by the week. He's like, depending upon which store you go to, then you wind up being able to find wood at totally different prices because they're selling it at the cost that they bought it at, but depending upon when that particular place bought it, then it can adjust the cost. So there's certainly been a lot of volatility in the commodities market, which is why we don't generally recommend them as part of a retiree portfolio, right? Too much volatility for what it's worth. But they certainly warrant a conversation in today's world because there's a lot of things going on that are starting to ripple in a greater amount than what typically you would see in the commodities market, because you don't have that kind of a big upward movement. Again, last year was the best year in several decades for that commodities index. So we thought we would talk a little bit about some of the main factors that are driving that and how they might all sort of play out in the months and years ahead. And first, of course, there is inflation, right? And so which one comes first, right? Chicken or the egg? Inflation driving commodities, or the commodities driving inflation? Part of that, of course, is pent-up demand from consumers. A lot of folks staying home, wanting to rebuild, interest in remodeling, things like that. But also a lot of municipal projects as well. If you look at state and local governments, they're flush with cash, and so they've got a lot of money to spend. And so those are going to be projects, physical projects, that money is going to get used on because it's not recurring. A lot of this COVID money that came out, I mean, it's kind of a one-time increase in your cash coffers as a state and local government. And so you really can't, sort of do a project that's going to have a continuing, ongoing amount of payment or amount of obligation that you have to then include in your budget. A lot of this is just sort of one-time stuff. So what a lot of state and municipal governments are doing is it's building projects. So those are help to drive up the demand for commodities, which then helps drive up inflation. Similarly, if you kind of look at supply chain issues, obviously that can help to drive it as well. Technology, and that explains a lot of what's going on with copper. Technology world, copper is in all things digital. So you have a change in sort of usage or perspective or demand, if you will, particularly on the tech side of things. All of that is helping to drive up those costs of commodities. And so in inflation as well, and this is kind of the chicken or the egg, which one comes first, right? But there's about a 76% correlation since 2000 to the monthly returns on your commodity index and inflation, your CPI data. So a big high correlation for inflation versus the commodity side of things. So that story, that's obviously a big driver of the price of commodities. Of course, that helps to go a long ways to explaining why last year was the single best year in several decades for commodities just as a whole. The second, and this one can kind of cut both ways, is the story of China, right? The health of the Chinese economy is the big driver of what's going on in the commodities area because of the demand. They are the primary driver in a lot of the commodities markets. Think cement, things like that. They account for about 55%. China alone accounts for about 55% of all metals demand. So big driver. As their economy goes, so goes the commodity markets as well. But when you think about what's going on in China, they have been very dramatic on their COVID lockdowns. That's starting to really kind of show in some of the economic data that's coming out. And so certainly some of their crackdowns in the private sector, which we've talked last month at length on the program, those types of crackdowns, particularly in the real estate sector, are helping to perhaps slow down that demand. So the China story could potentially cut either way on that. Certainly they are the big consumer. 55% of all metals consumption is through China. But if they're starting to crack down on some of that stuff, that may reduce down demand. Third is, of course, green technology, right? The notion of we want to shift more to greener providers of our power. But it's not a zero-sum game, and I think that's what gets lost in the argument. A solar panel takes a lot of metals. A battery takes a lot of other types of metals. And so we're, to a certain extent, I think we're trading off one thing for another. It's not this zero-sum game, because what's getting overlooked is the demand for copper has increased dramatically as a result of this shift, if you will. If you combine that with some of the environmental, sustainability, governance types of factors that a lot of people like to overlay on investment choices these days, well, guess what? You wind up with, say, copper, for example. A lot of the easy places to get copper have already been tapped. So now to get it into some of these other places, it's a little bit harder to get. It might be more impactful on the environment, but then you've got these environmental factors now that are saying, well, wait a minute, we don't want you to disrupt the environment. It's one of those things where it sort of goes hand in hand, right? You're going to need some of this stuff for production of solar panels and batteries and things like that. But certainly the demand is not easy, because you're just consuming something of something else, because all of that stuff does take a lot of metal use. And then, of course, lastly is agriculture, right? Agriculture today, farming uses a ton of oil. And so consequently, if you're using equipment that takes oil, and oil goes up, then you've got to pass it on. I mean, some of that farming equipment can be easily over $1 million just for one piece of machinery. And so that cost then starts to get passed on to consumers. We've got some other thoughts on sort of how agriculture and changing consumer taste also helps to sort of drive the price of commodities as it relates to agriculture. So we're going to take a break. When we come back, we're going to continue this conversation about commodities and some of the big drivers here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to the program, ladies and gentlemen, talking about a little commodities discussion, if you will, on the program. Certainly, commodities have gotten a lot of attention of late, predominantly because they had one of their best years in decades last year. The Bloomberg Commodity Index for the calendar year 2021 up 27%. So what drives commodities when we think of that? Well, it breaks down into sort of four categories. In the prior segment of the program, we talked about sort of the first three. First and foremost would, of course, be inflation, right? A little bit of almost a chicken and the egg story sort of on that. Like if inflation is driving commodities, or does the increased cost of commodities drive inflation? Regardless, inflation a big driver in terms of how commodities prices fare. If you look at the correlation between the performance of commodities and the CPI on a monthly basis, you'll find that it's about a 76% correlation month in, month out. That means there's a high degree of correlation between what's happening in inflation and what's happening with commodity prices. Number two, you got to throw China into that conversation. They're the 800-pound gorilla, so to speak, out there in the commodities marketplace, assuming 55% of metals demands is coming out of China. So as the Chinese economy goes and Chinese demand goes, then so too does that help to drive the overall markets themselves, for commodities along the way. Thirdly is this notion of green plus technology. So the combination of that is important because so much of what we do, just even around the house, is technology related. Well, any of those new devices, any of those new things are obviously going to be, are obviously going to be much bigger consumers of some of the metals out there. Anything technology, anything digital, probably chances are that it's using a bunch of copper. Similarly, this bend towards we want to become more environmentally friendly in how we're producing power and things like that. Well, that doesn't exist in a vacuum. If you're reducing down your use of oil, you are increasing your use of metals, including rare earth metals as well. So there's a trade-off there when you create these batteries and things like that. You are creating a different hazard of a different flavor. So, but the reality is that's the shift. And so that has kind of driven some of the uptick on the commodity side as those desires or those demands sort of shift, particularly the tech side of things. And then lastly, we're talking a little bit about agriculture. Certainly a big part of that overall commodities picture. It's not just commodities. When we talk about that, it's not just about metals or oil. It's also about things like soybeans. And so if you think of that, and certainly consumption of oil, agricultural and farming equipment uses a lot of oil when it comes to how all of those $1 million plus machines actually run. And so then that cost obviously getting passed on to consumer. But again, we see changing behavior in the agricultural side as well. There's a higher demand for farming. And as more and more of the population, particularly this time of year, right? Everybody got their New Year's resolution. Oh, I'm going to eat healthy. I'm going to eat more greens. I'm going to do, more fresh vegetables, things like that. Well, that means that the demand for agricultural products has certainly gone up. Interestingly, we saw this statistic that we wanted to share with you as it relates to this. If you look at the 7-year span from 2014 to 2021, the number of vegetarians in this country rose by 500%. So pretty significant change in demand and tastes and things like that ultimately serves to drive what's going on in the commodity market. So that's sort of the story. The four main drivers, if you will: inflation, China, tech, green, and agriculture. Those are the big impacts of what's going on inside the commodities market. At the end of the day, folks, the commodities market has a history of being relatively unpredictable and highly volatile. So our advice on this piece is certainly good to have an understanding of how it all works, what it all means. But at the end of the day, we would not encourage folks to chase the behavior of the commodity markets just because it finally had a decent year in the year last year. So stay clear of that. Shouldn't really be part of the overall portfolio, particularly if you are a retiree, but certainly something that folks should really understand and appreciate in terms of how it works and how it relates to everything that we do as consumers of products each and every day. So speaking of consumers of products, One of the things that we like to do, and I guess this is a website is a product, right? So one of the things that we like to do on our website at Nelson Financial Planning is we like to post various blogs and topics of interest on a regular basis. So this past week on Thursday, we posted our latest blog about a variety of things. And so we thought it would be good to mention some of the headline topics that we talked about in the blog post we did this past week. Because if you're interested in learning more or reading more, just visit our website. If you go to Nelson Financial Planning, there's sort of like a banner that has like different things that you can collect. In the middle, it says blog. So if you click on the blog, then you'll wind up seeing our most recent blog post. It's also a video and stuff like that that goes with it. So anyway, on the blog post, we talked about a variety of topics, talked a little bit about government spending, the massive spending problem that is our government, the fact that with interest rates going as low as they are, it allowed the government to borrow more money. The recent uptick in interest rates is going to serve as a pretty decent restraint on that ability, because it doesn't sound like the politicians have much of a restraint, but maybe the practicality of not being able to borrow at as cheap as you were, having to borrow at a higher cost, which increases the cost that the government has to pay on said debt along the way. That may be the bigger driver of how things slow down. Similarly, a conversation about interest rates, low interest rates, not very good for savers. What can you do in that particular case where you're not making a whole lot on your savings account? Our suggestion is you look for more dividend-paying stocks, things like that, that will help to generate out some income along the way. There's a number of companies that are worldwide that are paying dividend yields of more than 3% currently. Certainly, that might have some appeal over sitting cash in a savings account making less than 0.5%. Also, of course, with any blog post at the beginning of the year, talking a little bit about the updated retirement plan contribution limits for 401ks, 457s, 403bs. There was a $1,000 increase up to $20,500. If you're over 50, you can throw in another $6,000. No real change on the limits for IRAs or Roths. And then lastly, the blog post for January that we posted this past week on the website at Nelson Financial Planning had some tips for how we can produce better college graduates, specifically from a financial perspective. So 4 good tips for college grads or recent college grads, folks that are just new to the workforce, to really look at and get to know to help improve their overall financial picture. So if you're interested in reading a little bit more about any of those topics, check out our blog post on the website at Nelson Financial Planning. In the meantime, we will wrap it on up and get it on out of here. Stay warm out there. It is quite cool today. You've been listening to Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.